Welcome, everybody, to another episode of the Directed IRA podcast with yours truly, Mark Kohler, and the infamous Matt Sorensen. Excited to be here. And for those that are catching this on the podcast and not YouTube, I just want to point out that I'm wearing a jacket and look far more professional than Matt Sorensen. And I think that's important that I just point that out. Because usually you look much better. So
why'd you have to reveal me? Everyone on the podcast, nobody knew. You like call me out.
I know, Matt's wearing a t-shirt with a mustard stain. And it's disgusting. Really.
Jeez.
No. Matt's always the professional one.
It is summertime, so that's why I'm wearing my tank top and shorts and flip-flops today. All right. And and Mark's in his tuxedo today.
Now it's getting
Now
ugly.
you guys are going to have to get to the YouTube channel. By the way, it's on Matt's YouTube channel, but, Direct Eye Podcast. But, all right, we were talking about summertime and a cool tax strategy for summertime that totally relates to what we do at Directed IRA every day, what you can do self-directing, and that is the Kids Roth IRA.
Oof. Now, some of you may have seen the title and you're like, what are they promoting, a Kid Rock concert this summer? No, we're talking
about we are, but not on the podcast.
Yes, fair enough. We're talking about Kid Roths, R-O-T-H apostrophe S or S apostrophe, whatever, however the context is. But no, this is so important. Now, we got to give a couple disclaimers here. First of all, let's get real. We know that with a Kids Roth IRA that has $3,000 in it, $2,000 in it, $5,000 in it, I get it. That's not enough sometimes capital to really do much. But right now, it's a snowball effect. You're going to start the process. You're going to be building it. You can make that Roth a partner with your other LLCs. And there's so much I'm going to leave it at that. But I just want to say right off the bat, we recognize that. But there's some bigger concepts here. Can I get you on board on that one?
Oh, yeah. And by the way, if you're thinking about putting money aside for your kids and teaching them how to save and invest, you would be a fool to just go open a brokerage account. You would be a fool to go open up a traditional IRA. You would be a genius for using a Roth IRA, okay?
And investing in something you know.
Yes, even take it one step further. But the Roth IRA, remember, think of this, we all love it for ourselves because we don't pay income tax on it when we take the money out later at retirement. This is the tax-free vehicle, the only way to legitimately make money tax-free. And if your kids start it, and everybody's seen the compounding charts and everything about that, and you think of how they can double their money, let's say at 10%, you're going to double your money. What is it, every 7 years?
Yeah.
And so...
And at the lowest rates of return and known to man.
So think of them that type of money over someone investing for 50 years. It's incredible what type of returns they can have. But why the Roth? Well, they don't need tax deductions to do a traditional account.
Yeah.
Who cares about? They don't pay income tax. They can't use a tax deduction, right?
Yeah.
And why go set up a regular brokerage account or some or a custodial account in their name? They're going to pay taxes on that and start filing tax returns and everything. And you don't want to be using this money today anyways. Teach them to build long-term wealth.
Yeah, and the Roth IRA can be started at any age for any child that has earned income, which is going to bring us back to the summertime strategy of employing your kids in your business and utilizing them in your rental properties. Even there may be working down the street, babysitting or cutting lawns in the neighborhood. We're going to talk about how you fund this in just a moment. But conceptually, people, I cannot emphasize this enough. These Roth IRAs grow tax-free, come out tax-free, and you go, well, they can't touch it till they're 59 and a half. Yeah, and that's right, and it's good. We don't want them to touch it. But... side note, they can pull out any contributions for college and let the earnings continue to grow. So you're building a college savings account at the same time. I love what Matt said. You're teaching about investing. You're getting them involved in the process. So powerful. So it's just...
Let's say your kid is like 12, okay? And you're like, all right, Matt, I'm going to put 6 years of contributions in here. Now it's $6,500. I have to use a calculator to do this. Okay. When it was $6,000, I could do it. Okay, $6,500 times 6 years. That's $39,000 of contributions that I'm going to be putting in for them while they're kind of still in my house. They're working, they're out there doing whatever summer jobs, or maybe you're employing them in your own small business. Let's say that they hit 18 and they want to go to college. That $39,000 you can pull out. There's no tax, there's no penalty. It's only the earnings. Let's say that $39,000 is now worth $70,000. Well, that extra, let's see, what do we got there? 31,000 on top of 39. That's all earnings and investment growth. That has to stay in the Roth. You can't pull that out without a penalty. But all the contributions you put in, you can pull out at any time, no tax or no penalty. They want to go to vocational school. They want to go do church service. They want to go to college. They want to buy a small business, buy a house with that money. This little starter, that all the contributions you put in can come out totally tax and penalty free. Okay. So don't think that this money is entirely locked up. All the contributions are still accessible.
Yeah, and I just ran a quick calculation on this. I've got different investment calculators on our websites. Listen to this, folks. $5,000. Now, by the way, before I tell you this number, just keep in mind, there's a tax write-off for you in this whole process. It's going to blow your mind. We're just talking about why you do the Roth and why it's so kick butt for your kids and for you and teaching concepts and all that. But guess what? When you hire your kids in your business this summer, you get a tax write-off. They don't pay taxes, and you're building the Roth. We're going to come to that in a moment. But here, check this out. $5,000 initial contribution. Let's say you got a 10-year-old that helps you out this year with your rental, your small business in the summer. You put them to work, $5,000. You pay them, you get a tax write-off. You put them $5,000 into the Roth. And then every year, now this is a 10-year-old. So we're going to assume, again, for the next 50 years, until they're 59 and a half, which is 60 years old, they're just going to put in $5,000. That's it, just $5,000. Don't even think about, matching 401ks in their future job or their own savings. Just say this little, nugget that you're going to start right now, $5,000 a year, every year, and we're going to assume a 10% return. You know why? Because you're going to self-direct. You're going to do better than Wall Street, and you're going to do better than 10% some years, maybe less than 10%. But we know you can average that when you invest in what you know. Don't even get me started on real estate ROI. So 10% return. 50 years, just $5,000 a year. Do you want to guess? What's the ending balance at age 59 and a half? Guess.
$1 million.
More.
$1 billion.
Okay, I know you're trying to pull a little. No, come on. How much more? Come on.
Austin Powers. Come on.
I know. Man. Yeah, it was good. It was good. Austin Powers. How much?
Sir, Evil Industries made $1 billion globally alone last year.
What do you think is in the Roth? More.
5.9 million.
More. 6.7 million in a Roth IRA at 10%.
Wow.
$5,000 a year. That's the power of compounding interest, people.
And time works.
Is that crazy? Your total contributions are only $250,000 and a starting amount of $5,000. And you're doing it just every year and investing as a family. Now, let's say you just do half that. You just provided your kids with a $3 million tax-free savings account and taught them the American dream. So powerful.
Yeah, so powerful.
Where's a pen? I need to drop a pen or a mic or something.
Yeah, and I think this is one of those lessons for kids, about what is investing and how does that work? And this is time to get together with your kids about what they're doing. I've done these kid Roth IRAs for my kids, And in fact, my youngest daughter now has a job. She's worked in my business and I've paid her, but she's got her job. I'm going to start her. She's my last one to do a Roth IRA, but she's got a job that she has had through school and in the summer working at a restaurant. But even though your kid might be making money and they're not putting it in the Roth, this is where you can help them, okay? Because they have earned income from somewhere. It doesn't have to come off their paycheck if they have a summer job or whatever. We can help bridge the gap for them. Now, if they're working in your business, we're going to go through a process on how that works. But for the one that's doing the babysitting and they've spent the money, or they got their job, they're doing lifeguarding, they're mowing lawns or whatever, and they've spent the money, you can help bridge the gap and get them this money up to the amount of earned income that they had.
Okay, so let's give you very specific.
Max of $6,500.
Yeah, okay, so let's get really specific. Let's go option one. There's probably three or four here. Option one, and I like what Matt just said, your kid, you don't have a small business that works for them, in some sort of methodology. So let's just say option one, this summer, your kid's working at McDonald's, mowing lawns, babysitting, lifeguarding, any of those. And let's say you talk with them and go, how much you make in a week? How much you making this year? And they make $5,000. That's what they're going to make. Do they need to file a tax return for that? No, they're under age 18. Their standard deduction this year is $13,000 plus. They don't have to file a tax return. At the state level, they might have to, but under $5,000, I don't think there's a state standard deduction under $5,000. I've got a table for that, whatever. But your kids aren't even filing a tax return, right? Do your kids file tax returns when they babysit? No. But did they have earned income? Yes. Now, Matt just said they spent the money. So under option 1, your kid's got this part-time job, they make $5,000 and they spend it. You can now gift them under the gifting exemption, which is $17,000 this year. You can gift them $5,000 and put it in the Roth for them. Now, you didn't get a tax write-off to do that. This is just option 1. Your kid has a job. You don't have a small business that works for this situation, but you want to help teach them how to save. You can fund a Roth through a gift to them up to the amount of their earned income called Directed IRA, directedira.com. Open up a kid's Roth account. We literally have that so that you know what to do, and you can open the Roth account and fund it. Then on day 2, you can say, I'm going to invest this with an LLC I'm doing or whatever. But the point is option 1, kid just has earned income. You gift them what you need to do.
Yeah. Now, option 2, though, is for any of you small business owners. And this is where the strategy gets even better. Because not only are we talking about funding a Roth IRA for your kid and this tax-free vehicle and all this investment growth and the compounding, and they're starting at a young age and all this great stuff that we've already hit, we're also talking about a tax deduction for you.
I love it.
Okay. There's something in it for the parents, too, here. Okay, if you have a business, and I'm even including the rental property here. You've got an LLC, you've got a side hustle, you've got the rental property. Pay your kids from that business, have them be working in it. They need to legitimately be working in it, make them I mowed the lawns at my dad's rental properties, I didn't get a Roth IRA out of it, but, I did get paid a little bit.
Yeah, love it.
So, and
may I add, if they're not an S corp, it's just going to be an other expense.
I was waiting to let you hit that.
No W-2, no 1099. So in any LLC structure, side hustle you have, it's a Schedule C. You just put it as an other expense on page 2. No W-2, no 1099. Don't jack it up. Don't listen to your accountant if they say, you got to issue a W-2. Send them this freaking video. They can go to my book. They can go to my CE courses on this. I'm a legitimate accountant and lawyer and teach this. And if you're an accountant out there freaking out that you've got to issue a W-2, you don't. Practically, you don't. Because the penalty for not doing it is the tax withheld. You didn't have to withhold anything. Do you see the point? So get over yourself. So no W-2, no 1099, other expense. You pay them out of your side hustle.
Yeah, and there's a specific exception here for family businesses where you don't have to do this withholding. That's what we're talking about it here. So now that they have earned income, you can go open up the Roth IRA of the earned income you paid them. It needs to actually hit their bank account. So they'll need to actually have a bank checking account in their name. You could be a co-owner on that with them, though. And then, and now the contribution is going to come from their bank checking account. Now, when you open up the account at Directed IRA, we're just going to make you indicate and certify that the child had earned income.
With a box that you check.
Yes.
That's it. We trust you. We love you.
Yes. The IRS trusts you in reporting your taxes to them. We do too. Okay, we trust you. Now, some companies that do Roth IRAs for kids, there are some, Fidelity being one, will make you verify their income. They'll make you provide a W-2. Yeah. Well, if you're a small business owner and you're like, I paid them on my business and I don't have to do a W-2, am I going to generate a W-2 just so I can get the Roth IRA in?
No.
Not with us.
No, not with us. Fidelity doesn't trust you, but we do.
Yeah. And Fidelity doesn't love you.
We do. Yes. We want to make your life easy. We actually believe in Main Street businesses. We believe in the small business owner, and we don't need to be a stick up your butt Wall Street brokerage that makes your life miserable. So if you can verify with the checking of a box that your kid babysat and earned $5,000 or worked for you and earned $5,000, we trust you. Now, you get audited and you can't prove it, that's on you. Yeah. So when you're checking that box, you're essentially telling the IRS too, we can prove this.
Yeah. Now, why don't you talk about the S corp though? Because so many people are S corporation owners and may want to do an S corp, and I got one little variation on that I want to throw in too.
Ooh, okay.
Little secret strategy coming.
Ooh, okay. Yeah. All right. I'm excited to hear this. Many times people, it is fun when I'm on the show with Matt. I wouldn't say always, but at least 80% of the time, and I could be that bold, I learned something from Matt here. And I hope many of you listening, you may get sick of our dumb humor, but there's always a golden nugget in here somewhere.
Yeah.
So I'm excited to hear what your strategy is. Okay, so here's the basics. If you have an S corporation, Matt and I have been doing this for years. You don't think some of my clients get audited once in a while, or people come to me that have been audited? We have a massive operation that we've been doing for 20 years. We have never had a client audited for paying their kids and having a problem. Ever. I've had audits with state and feds looking at my clients for their 1099s and W-2s. And as soon as they see that they're paying their kid, they're like, well, we're good. They're going after all the people that my clients are trying to pay as a 1099. There should be a W-2. That's what they're after. That's where the money's at. They don't care about the kid payments. They know there's an exception. So again, you CPAs and attorneys out there that are cringing during this podcast, relax. Holy hell, it's okay. So anyway, if you're an S corporation and you pay a kid out of an S corp, yes, you have to issue a W-2 or 1099. So kids over age 18, you're going to kick out a 1099. And if they look like an employee, you're going to do a W-2. But with the kids under age 18, do not pay them out of your S corp. You're going to set up a little sole proprietorship. It could be an LLC. It could just be a plain old sole prop janitorial business with a DBA or a simple under your social Wells Fargo account. And you go open up this little sole proprietorship, and that's a support company to the S corp. And it might provide marketing, paper shredding, cleaning, janitorial, whatever that your kids are going to do legitimately. And your S corp takes a deduction on the 1120S as an other expense as a management fee, because they're going to pay this little support company a management fee to do certain tasks. Then this Schedule C is going to pick up the income and pay its workers, not employees, because then you start thinking W-2. Get away from the W-2. You're going to then take that payment to the kids and put on as an other expense for outside labor on page 2. That's right, people. I'm going to give you the exact procedure here. There's no hide the ball. Page 2 of the Schedule C, other expense, pay the kids, zero out the Schedule C. So your S corp got a write-off as a management fee, picked up the income on a Schedule C, paid the kids for outside labor, no withholdings, no W-2, no 1099, with kids under age 18, zeroed out at the Schedule C. Your kids don't even have to file a tax return unless it's over the standard deduction, federal or state, and now they have earned income to open the Roth. Now, I know that may have sounded complicated, but it's really not. Once you do it the first time, it is autopilot, and you freaking do it year after year after year, and you're building college savings, you're building wealth, you're teaching your kids. It is freaking awesome. That's the basic procedure. Now, What's the secret sauce? I'm dying to hear.
Okay, here's the one. I've had some clients do this one. I think it's pretty cool. What about my clients, and you have them too, I know,
okay,
that have a solo 401k,
Ooh.
All right? And they want to do some Roth dollars for their kid that works in the business. Well, you know what? In our solo 401k plans, your spouse can be involved in the solo K and have their own account, which can be Roth or traditional. Your business partner can, and also your kids.
They're not discriminated?
They're not discriminated against. They can be included in here if they work in the business, and they can have a Roth solo 401k account where you can be putting up to 20 grand plus of Roth dollars or more, legit, as long as they're working in the business and worth that. And now we're getting on top. And this, by the way, this is in addition to the $6,500 you'll be doing in a Roth IRA. So I do have some clients, some real estate clients in particular, who will self-direct their kids' Roth 401k account and put it into deals with them. Now, one little common question that comes up once you're really in the mix of this with a kid is you're like, well, wait, this is my S corp that has the solo K. I don't want my kid to get a W-2. Okay. We're going to have an affiliated additional employer under the plan of this family management company.
Oh, right? I like it.
And that's how we're going to bring over the kid
just
to
learned
make
that.
the solo K.
You know what I was going to say?
What?
I love you. I learned something new. I was going to say if you
Were you going to shoot it down because of
No.
Okay.
I was going to just say, well, I thought what you were going to literally say is that you have to know that if the S corp is sponsoring the 401k and said the kids are going to play in the 401k, which they're allowed to do, and it's solo. You think solo, it's just you. But no, it includes your partners and your family.
Yeah.
So the kids are in. I thought you were going to say, do the W-2 for the kids, but zero out the withholding. You don't have to do any FICA or state or federal withholding. So you can just zero out the W-2, but do the W-2 just so they can participate in the 401k. But you're saying you don't even have to do that because it's an affiliated employer relationship.
Yeah. And sometimes you got to add an additional employer, different plan documents, call it in a different way.
I love that.
And so sometimes we have clients every once in a while that have, they have their S corp and some other thing. Sometimes the family management one's the one I've ran into where we add as an additional employer.
Wow.
So you still can't have other employees in it, by the way. It's just got to be the kids and you and your family here. So this solo K works, and then we get some Roth solo K dollars for the kids.
Wow, I love it. Okay, so there's some procedures. Now let's do some examples. Let's have some fun. Later today, some of you are going to be catching this recording a day or two or weeks or months later, yada, yada. But what I try to go live on YouTube every week. And I do it on Facebook with Entrepreneur Magazine. I'm a senior tax consultant for Entrepreneur Magazine. We go live on their Facebook every week and YouTube. My topic this afternoon is how to write off your RV. So how can I write off my RV? Now, I almost had the CEO of Outdoorsy come on the show today. We weren't able to book him. We hope to have him come on.
Okay.
Outdoorsy is the #1 app of how to put your RV that's sitting on your side of your house doing nothing half the year.
Yeah.
You can put your RV in Outdoorsy and rent out your RV like an Airbnb. So now your RV becomes a business entity, a business asset. So now I can write off your RV as a little quote unquote Airbnb, and your RV is creating cash flow when you're not using it. Well, why don't we have the kids help clean the RV when it shows back up? Now the kids are working in the business. They're learning how to clean the RV. Of course, you're going to have to go and redo it, but you're going to learn. They're going to learn how to clean maybe. And so your RV becomes a tax write-off, creates cash flow. Your kids are learning how to work in a business of renting the RV, and now you can pay them for cleaning the RV, which further reduces the taxable income of renting the RV, and now they can open a Roth. See that circle? It's freaking amazing.
Yeah.
There's just an idea. So if you haven't seen that video, get over to my YouTube channel, Mark J. Kohler, and or just search RV write-off Kohler, and you'll see my videos. Go watch it. I'll be covering that later today.
I love that one. Yeah. I mean, I think there's so many opportunities to get the kids involved. This is think of your entrepreneurial spirit, the things you're already doing, things you want to do. For those of us that have kids, getting our kids involved in it can be one of the greatest lessons we can teach our kids. How to work, how to overcome problems, how to have to deal with the customer, and cleaning the RV even, or working in a rental property, and just seeing what's going on in the real world. Get them out of the classroom and off their devices and stuff like that, learning this stuff. And also help them teach how to learn, invest, and save it. Because we all want to teach our kids, and we want this for ourselves. It's we want to work, build assets to invest and grow so that we're not always working our butt off.
Yeah, I like what you just said. I want to throw this out to everybody, because if you're watching the show, you obviously hopefully have a kid or a grandkid. We have other strategies for the grandkids. And by the way, do a consultation with one of our tax lawyers. Get over to the law firm, kkOSlawyers.com. It's down there in the description. Meet with one of the tax lawyers and go, hey, I'd like their show on this, but how do I do this for my grandkids? And tailor it to your situation. What state are you in? What type of business do you have? Guys, if we don't save you 10 times whatever you pay our tax lawyers, we failed. We're not that expensive. Holy hell. Get online and do. Did I swear too much today?
Yeah.
Are you okay?
What's expensive is paying the IRS more than you should.
Yeah, that's expensive. Okay, so here, I just want to throw this out too with this kid thing, and all this. You know what? Matt and I were talking, you don't know, but I'll just say, Matt and I were talking, I'm talking like Tristan here, our producer's like, I know, because I was sitting here. But right before we started the recording today for the podcast and YouTube, we were talking about Airbnbs. Matt and I are investing in real estate constantly. We own our own rentals that rent to our business and yada, yada. And I'm in the process of picking up 2 or 3 Airbnbs in a little portfolio. And in this process, this is another opportunity. Again, another example of getting our kids involved. And didn't I say that? I was going to say, yeah, I'm going to be involving my kids in the management of these Airbnbs. Yeah. And Matt said, you're not going to be doing this, are you?
That's exactly what I said. I'm like, who's managing these? I'm like, and he wanted wanted the kids.
Yeah, I envision my grandkids working these Airbnbs. So it's going to be great. So, but see, this is the beauty. Do you have kids going to college?
Yeah.
Are you buying duplexes where your kids can manage the duplex or rent out rooms? I had a client recently buy a 4-bedroom in Salt Lake City on the bench right outside University of Utah. Go Utes. Yeah. And they're predicted to go well this year in the football season.
I hope so.
Yeah, and I know
that Rose Bowl loss, 2 Rose Bowl losses.
It killed. It hurt. It hurt. And Oregon and USC, they're always powerhouses, but Utah, man, they're there. Mm-hmm. So anyway, he bought a 4-bedroom on the bench in Salt Lake City, and his daughter's going to University of Utah, and she's in the house and rented out the 3 other rooms. And the rent is paying for the mortgage on the property. It's a rental property in an LLC. And it's cash flowing, and he's not paying for his kids' rent to the university in on-campus housing, and he's getting a tax write-off. And every time he travels to Utah to go see his daughter or go to a football game, it's a tax write-off because he's going to check on his rental. You see that? I mean, it's not just kids under age 18. It's what's your kid doing in the next stage of their life, and how can you work together? It's just so powerful.
Yeah, man, we're bringing it all together today. I love it. This just all came together so nice.
Yeah.
Well, we got lots of resources. So directedira.com. Remember, we got our kids Roth app specifically. If you're interested in a solo K for yourself, or maybe you already got one and you maybe just need an account for one of your kids, get in touch with us there too. If you need some consulting on this, our law firm, KKOS Lawyers, we're there for you. Any other tax or legal planning you need. As you can see, we're trying to be creative with these strategies because that's what wins. You've got to be creative with the strategies in your situation. Know the tax code out there, know the vehicles that work. How can I save? How can I get a tax deduction and a Roth for my kid? I mean, I love this strategy.
Yeah. And you know, I just want to say this too. I like what Matt just said, and it prompted me to say this. You don't have to fire your accountant to hire us. You don't have to fire your lawyer to hire us. We're not saying that. And we don't have these massive $5,000 or $10,000 or $20,000 retainer fees and you got to come all on, or you come to our mastermind group to be a part of this. No, just do a freaking consult, get a second opinion, get a strategy, and then take it to your advisors and go, I really want to do this. Now, if your advisors have questions, that's cool. Let's get on a call. But if your advisors are poo-pooing this and they're not coming up with ideas and they shoot it down, maybe you've got the wrong advisor. Seriously, if you're bringing ideas to your advisors constantly and they're shooting them down, do you think the relationship is dysfunctional? I do. I mean, that's...
Yeah, I mean, any therapist in the tax world would definitely agree.
Yeah.
Yeah,
So,
it's a dysfunctional relationship between a CPA and customer.
now, if you've just bumped into this podcast, I'm going to be sending this out on my social media, and you're like, holy crap, these guys they're talking about things I've never heard of. Please go back on this podcast, the Directed IRA podcast, and go back to the beginning. Listen to the first 10 to 15 episodes. When we started this podcast 2 or 3 years ago, this is a sister podcast, by the way, to Main Street Business. But we wanted to make sure our first 10 to 15 episodes really took you through the basics of these concepts. They're easy to listen to. Hit them in the gym, get them on the treadmill, and just start educating yourself on these things, because this is exactly what Wall Street doesn't want you to know. Truly. And this is so common. This is what Peter Thiel with PayPal and Facebook has, Mitt Romney. We could go on with the list of over and over again of powerhouse investors around the country that have these mega Roth IRAs. They've learned to self-direct their Roth IRAs. You can unlock this secret too. Do not just listen to the rank and file stockbroker that's telling you that stocks, bonds, and mutual funds are the only menu item. It's wrong.
Yeah. Well, thanks everybody for being with us.
Alt Asset Summit, come on.
Yeah, thanks everybody for being with us. We will be at the Alt Asset Summit. All right, that's going to be June 29th and 30th in Costa Mesa. Go to altassetsummit.com. We have 12 plus speakers, amazing 2 days of learning about different investment options and ways you can invest off of Wall Street. Okay, you don't have to be, you can have a little Wall Street in life if you want.
Sure.
But don't be totally beholden to it. We're going to go over these alternative assets and things people are doing that aren't that crazy, like real estate. You know, I don't know how that's in the alternative category, but it is. It is. You know?
Apparently, yeah.
So
that's
because Wall Street doesn't sell it, you know, so it's in the alternative category. But it's going to be amazing 2 days. So altassetsummit.com. You can be there in person or virtually. And until then, until the next podcast.
Well, and if you miss the Alt Asset Summit and you're catching this video or this podcast after the fact, you can pick up the recordings there. And if you're at directedira.com, we have monthly webinars, we have ongoing blog articles and the podcast. We want to make sure that you're educated on this so that you can control your money. And I'm not trying to be infomercial salesy here. I'm really not. I just want to make sure that you have those resources out there that you can share with your family, your friends, your kids. Have your board meeting this summer. Get your kids on your board. Type Board of Directors, Small Business Kohler. Just put that on YouTube. Board of Advisors Kohler. Just put that on YouTube. I've got videos on how you can implement this summer, because AKA family reunion equals tax deduction. So
it better.
Better.
There's got to be something good coming out of that.
All right, I will not cut you off again. Take us out of here. Give everybody that last piece of advice.
Last piece, guys. Stay calm. Self-direct on. See you next time.